Welcome to the Playing Books podcast. Today we're doing something a bit different. Instead of our usual format, we're dedicating our time to just one book. It's a really powerful one, The Psychology of Money by Morgan Housel. Think of this as a focused deep dive designed to give you, our listeners, some really valuable takeaways on money. It affects everyone, right?
Absolutely. And what's great about this book, I think, is it's not about, complicated charts or secrets to get rich quick. No, it digs into something often missed,
Hmm.
our own behavior around money. The core idea, and we'll keep coming back to this, is that doing well financially, it's less about how smart you are, surprisingly, and much more about how you act. And that skill, well, it's tough to teach, even to really intelligent people. We think unpacking this is going to be useful for you right away.
Yeah, definitely. So over the next maybe half hour or so, we'll pull out some key ideas, some great stories, maybe a few memorable quotes. The goal is really to give you a fresh look at your own relationship with money. And we want this to be active for you listening. As we go through these points, think about how they connect with your own life, your own decisions. Our mission today, distill the wisdom here and show how these psychological insights can genuinely, enhance your life.
Okay, so where to start? Let's jump in with the story that really grabs you right at the beginning. Ronald Reed, his Wikipedia entry, it's something like American philanthropist, investor, janitor, and gas station attendant. What jumps out at you there?
It's the mix, isn't it? Philanthropist, investor, janitor, gas station attendant. It's not the combination you expect. I mean, this guy, seemingly ordinary life, built up this surprising fortune. It just flips your assumptions.
It really does. And the book contrasts him so well with, like, this high-flying executive, the kind of guy who, flashes cash, probably super smart on paper, but ends up bankrupt. Ronald Reed's story just nails that core idea right away. Behavior over brains when it comes to money. Consistency, mindset. That matters more than pure IQ. Your financial EQ, maybe.
Yeah, financial EQ, I like that. It makes you wonder, though, why is money so different? In medicine, say, intelligence seems key. The book says finance is more like psychology than physics. Can you unpack that a bit?
Right. So think about physics or medicine. There are rules, laws, you make progress based on discovery. We could kind of expect finance to work like that too. But Housel argues, convincingly I think, that money is just drenched in human emotion, biases, weird decisions. It's messy. It's psychology.
That makes so much sense, especially when you consider his background. He started writing about finance around, 2008, the big crisis.
Yeah.
And he mentioned how even the experts back then couldn't agree on why it happened or what to do. Just contradictory explanations everywhere.
Exactly. That whole period just screams human element, doesn't it? It wasn't just about spreadsheets and models. It was about fear, panic, the stories people told themselves to make sense of the chaos, which underlines the book's point. We teach money like it's math, but we live it like it's, well, psychology.
And those personal stories,
Yeah.
our experiences, they shape our individual psychology of money so deeply. The book really hits on that personal history aspect.
Oh, massively. I mean, imagine growing up with hyperinflation versus stable prices. Your view on saving, totally different. Or if your family lost everything in a downturn compared to someone who only saw markets go up. Your idea of risk is just miles apart.
The book gives such good examples of this, how these experiences create entirely different worldviews about money. It's not about who's smarter, it's just
Yeah.
we all see it through our own unique lens.
Mhm.
And like the book says, your personal experience, even though it's tiny in the grand scheme of things, it hugely shapes what you believe about how money works.
Which perfectly explains why two smart people can look at the same stock and come to completely opposite conclusions, right? It's their histories talking. And this connects to something else, a quote from Michael Batnick, I think. Some lessons have to be experienced.
Before they can be understood.
Yeah.
What does
Yeah.
that mean to you? Like, reading isn't enough.
Pretty much. You can read about the Great Depression, you can study the data, but that's not the same as feeling that knot in your stomach, that fear for your family's future. The book puts it so well. Something like spreadsheets show stock market declines, but they don't model the feeling of looking at your kids and wondering if you messed up.
Wow. Yeah. That feeling. You
Yeah.
can't learn that from a textbook. You might know risk exists intellectually, but until you feel the pain of a real loss, it's just abstract.
Exactly. Which brings us to luck and risk, often uncomfortable topics in finance. The book argues we tell these neat stories about success, all skill, no chance. But that's just not true, is it?
No, and the Bill Gates and Ken Evans example really illustrates that. Two brilliant kids, same school, same passion for computers. One becomes, well, Bill Gates. The other had a tragic accident. It makes you think how much is timing, chance, things outside our control.
Right. For every Gates, there are countless others who worked just as hard, were just as smart, but didn't catch that lucky break or maybe caught an unlucky one. Recognizing luck and risk the downside possibility gives you a much more realistic picture. It makes you question, was that bad outcome a bad decision? Or just bad luck hitting a good plan?
It's humbling, really. And
Eh,
because luck is so hard to pin down, the book suggests maybe don't try to copy the extreme outliers like a Warren Buffett. Instead, look for broader patterns. What's the advantage of that approach?
Well, the advantage is finding principles you can actually use, trying to be the next Buffett. Probably impossible. Luck played a huge role over, 70 years. But understanding broader themes like patience or the value of controlling your time, which we'll get to, those are things you can actually apply to your own financial life, much more practical.
Okay, that makes sense. And that idea of practicality ties into the concept of enough. There's that great little story with Kurt Vonnegut and Joseph Heller. Remind us.
Right. They're at a party hosted by a billionaire hedge fund guy. Vonnegut points out this guy made more money in one day than Heller earned from Catch-22 in its entire lifetime.
Hmm.
And Heller's reply is just perfect. Yes, but I have something he will never have.
Enough.
Exactly. Enough.
Such a simple word, but so profound in this context. It highlights how subjective wealth goals are. And the danger, the book points out, is that goalpost just keeps moving for some people, always needing more. Like the story of Rajat Gupta, immense success, but risked it all and lost it all, chasing more.
Yeah, that's the trap. And the book nails it. The hardest financial skill is getting the goalpost to stop moving. If you
Ah,
can't define your enough, you can end up taking crazy risks,
right.
jeopardizing the things you actually have and need for things you don't.
So true. Okay, let's shift gears slightly to compounding. The book talks about its power, but also how we often misunderstand it. It uses an ice age analogy.
Yeah, the Ice Age analogy is great because it shows how tiny, consistent changes like glaciers moving millimeters a year create enormous results over huge timescales. Compounding in finance is like that. Small, steady gains over decades, they build into something massive. It highlights that a huge chunk of Warren Buffett's wealth isn't just brilliant returns year after year, it's the time. He started as a kid, decades and decades of compounding.
Right, and the comparison with Jim Simons is fascinating there. Simons actually had higher average returns, significantly higher, but Buffett's wealthier. Why?
Time horizon. Simple as that. Simon started much later. He had fewer decades for those amazing returns to work their magic, that exponential growth. The book talks about how we think linearly addition is easy to grasp, but compounding is exponential, multiplicative. It's counterintuitive. Like even Bill Gates apparently underestimated Gmail storage needs initially, thinking linearly instead of exponentially about data growth.
It's a different way of thinking. So getting wealthy is one thing, but the book stresses staying wealthy might be even harder, or at least requires different skills. It uses Jesse Livermore and Abraham Jermansky as examples.
Yeah, cautionary tales. Both made fortunes, multiple times even, and lost them. They were good at the getting rich part, not so good at the staying rich part. It underscores this idea of survival. Staying in the game is crucial for compounding to work long term. You have to avoid those wipeouts. Michael Moritz from Sequoia Capital said something similar, didn't he? That their success comes from constantly fearing going bust.
That fear drives prudence, maybe. And avoiding the big loss, that connects to the idea of holding cash, too, right? Cash doesn't earn much, seems like a drag. But the book argues it has this hidden value.
Huge value. Its value isn't the tiny interest rate, it's that it stops you from being forced to sell your other investments when things get ugly. Selling stocks low in a panic because you need the cash. That's a catastrophic compounding killing mistake. Cash gives you options, lets you ride out the storm, that survival aspect again.
And survival means planning for storms you don't even see coming. The book emphasizes planning for the unexpected.
Definitely. I mean, look at the last 20 years. 9/11, the 2008 crisis, a global pandemic. Who had those in their 5-year plan? A good plan isn't about predicting the future perfectly. It's about having enough cushion, enough room for error, so when the unexpected happens, you're not derailed.
Room for error.
Uh-huh.
And accepting that some things just will fail. The book normalizes failure in a way I found quite helpful. Talks about tail events driving results.
Yeah, the idea that in many complex systems like venture capital or even the stock market, a few outliers drive most of the outcomes. Your average VC fund, most investments probably lose money or break even. A tiny number are huge winners and make the whole fund successful. Even with big public companies, a surprising number fail or underperform over time. It's not all winners.
Right.
So for you as an investor, seeing some investments not work out, That's normal. It's part of the process. The key is having a strategy that lets you endure, like Sue in the book's example, who just keeps investing steadily while others try to time the market and get whipsawed. Staying average, consistently, wins.
Consistency wins. And what's the ultimate win, according to the book? What's the real payoff of building wealth? It's not just stuff, is it?
Not at all. The biggest dividend money pays. It's control. Control over your time. The ability to wake up and say, I can do what I want today. That freedom. Doing what you want, when you want, with who you want, for as long as you want. The author shares his own story, leaving a high-paying finance job he hated because he valued his autonomy more. That feeling of control, psychologists call it reactance, it's fundamental. That's real wealth.
Yeah, and his point about achieving independence with relatively modest savings really drives that home. It's about options, not necessarily extravagance, which connects to that funny paradox about the fancy car. What was that again?
Huh? Yeah. The idea is people buy the fancy car thinking, wow, people will admire me. But when you see someone in a Ferrari, what do you think? You mostly think, wow, cool car. Maybe imagine yourself driving it. You rarely think much about the driver.
Sure.
The admiration is for the object, not the person. No. The book argues if you want respect. Humility, kindness, empathy. Those work way better than flashy things. And the punchline, real wealth is often what you don't see. It's the car not bought, the money not spent, sitting there providing security and options.
Invisible wealth. I like that.
Yeah.
And building that comes down to saving, doesn't it? The book makes a strong case that your savings rate is maybe the most important lever you have.
It really does. More important than your income. More important even than your investment returns, often. He uses that energy efficiency analogy. We got wealthier energy-wise, not just by finding more oil, but by using less energy to get the same result. Saving is like that for your finances, controlling your spending, increasing that gap between your income and your ego. That creates wealth, creates flexibility.
Yeah.
And saving just for saving's sake, not for a specific goal. That's your buffer against surprises. That's what buys you control over time.
Makes sense. Now, there's a subtle but important distinction the book makes. Being reasonable versus purely rational with money. What's the difference?
Okay, so rational might be strictly following the math, the optimal theoretical path, like maybe leveraging up to the hilt because technically it offers the highest expected return. But reasonable acknowledges we're human. Maybe pure rationality is too hard to stick with emotionally. So diversifying, even if it slightly lowers potential returns, that's reasonable because it helps you sleep at night, minimizes regret, makes you less likely to panic sell. Sticking with a slightly less optimal strategy you can actually endure is more reasonable and probably leads to better real-world results than trying a perfect strategy you abandon at the first sign of trouble.
So it's about finding what works for you emotionally and practically, not just on a spreadsheet.
Exactly. Even things like investing a bit more in your home country's market than is rational, or owning a few individual stocks just because you enjoy following them, if it keeps you engaged and prevents bigger mistakes, it can be reasonable.
Got it. But we shouldn't rely too much on past history to guide us.
Yeah.
The book warns about the historians as prophets fallacy.
Yeah, that's the danger of thinking the future will look exactly like the past, especially in finance. Things change. The economy evolves. Think about structural shifts like the invention of the 401k or the rise of index funds or venture capital. These things change the landscape. Older data might not be as relevant as we think. It's like that saying, the four most dangerous words are, it's different this time. But the book also quotes Sir John Templeton admitting, yeah, but it is different about 20% of the time. You have to be aware of potential shifts.
Which leads back to humility and needing that margin of safety we talked about. The blackjack analogy comes up here.
Right, card counting in blackjack. Even when you know the odds are in your favor, you can still lose several hands in a row due to bad luck. You need enough capital to survive those losing streaks. Your margin of safety in finance, extra savings, diversification, conservative assumptions, is your survival buffer. It lets you withstand the inevitable bad patches. It's not just being conservative, it's what allows you to stay in the game long enough for the good odds or those rare positive tail events to eventually pay off. Maybe assume lower future returns in your planning than history suggests, just to build in that buffer.
Okay. And part of staying in the game is accepting the price of investing, emotionally speaking.
Yeah, this is a big one. Investing isn't free. The price isn't just fees, it's volatility, fear, doubt, uncertainty, regret, all those uncomfortable feelings. Even the best performing stocks spend huge amounts of time below their previous highs. It feels bad. Trying to avoid that price, like trying to time the market perfectly to miss all the downturns, that usually costs you more in the long run. You have to see the volatility, the uncertainty as the admission fee. It's the cost of entry for potential long-term growth. You got to pay the fee to get the potential reward.
That's a great way to frame it.
Yeah.
The book also briefly touches on why pessimism sounds smarter and how powerful our own stories are.
Yeah, pessimism is seductive, isn't it? Bad news travels fast, sounds intellectual, good news happens slowly. And the narratives we construct, they drive so much. How we interpret events, the decisions we make, especially under pressure. Think Madoff people believed the story because the stakes felt so high.
Okay, so as we wrap up this deep dive, let's quickly hit those key takeaways again, the actionable stuff. Cultivate humility. Less ego equals more wealth because saving is that gap between ego and income. Manage money so you can sleep, be reasonable, not just rational.
Right. Remember, long tails drive everything. It's okay to be wrong, often if you survive long enough for the big wins. Worship room for error. Endurance is key. Avoid extremes because you will change. Your goals will change. Embrace that.
And remember, nothing is ever as good or as bad as it seems in the moment. Keep perspective.
Well, that brings us pretty much to the end of our special deep dive into the psychology of money. We really hope this chat has given you some aha moments, some useful insights into the behavioral side of finance.
Yeah, it's such a rich book, we've only scratched the surface, really. If any of this resonated with you, we absolutely encourage you to grab a copy of The Psychology of Money by Morgan Housel. Check your local bookstore or online retailers. It's worth a read.
And you can engage with the author, too. Morgan Housel is active on social media, easy to find online. He often shares more thoughts that connect back to these ideas. It's great content.
Definitely. So the challenge to you, our listeners, and we know you're a thoughtful audience, 18 and older, looking for insights like these, is to really let these ideas sink in. Think about how your own history shapes your money views. Look for chances to make more conscious, behaviorally aware decisions. Let it enhance your life.
Thanks so much for joining us on the Plain Books podcast for this special exploration. If you like this format, hit follow or subscribe so you don't miss what we dive into next.
And please, feel free to share this deep dive with friends, family, anyone you think might get something valuable from it. Until next time, thanks for listening.